Well, good morning, members. Got a lot to cover, so I'm going to jump right into it here. Essentially, we had another week of up, pretty much 1% across the board. The Dow was up more. Nike helped to contribute to that. Still down 4%, 3% here on the Russell, and up slightly elsewhere. So that comes on the heels of a 10 to 12, 13% drop to start the year. And at this point, here we are almost back to even across the board. If we look at the summary here, the biggest surprise last week was the Fed. We thought the Fed was going to surprise, but we thought the surprise would be on the hawkish side. In fact, it wasn't. It was on the dovish side. Despite the fact that there's less than 5% unemployment year-over-year core CPI at 2.3, the Fed lowered its forecast on the PCE inflated inflation rates, and they also cut their growth forecast. And as part of that, they said, we're not going to raise rates 4 times, maybe twice. And boy, that put some juice back into the markets again. It just keeps coming. There's a lot of folks now that are starting to talk about conspiracy, a Shanghai Accord. The G20 got together at the end of February. And if you look at what's happening, one can say, maybe something was coordinated, some sort of a coordinated effort there. I'm not sure that's the case, but if you look at these events, right, where you've got the negative interest rate policies and the QEs over in Europe and in Japan, you got the yen holding much higher, credit standards being lowered so that there's more borrowing taking place, and now the U.S. turning dovish, pushing the dollar down. You've got a lot of stuff here that says, well, maybe something's going on. Maybe these guys did get together and say, we're going to do something about what's happening. If we look at what's most important, it's the currencies, right? The currencies are driving the most significant market after that, which is oil. It's also driving the spreads lower on the credit, and it's driven the equities higher worldwide. And so really our focus has to be on these first two in order to decide where the others are going to go. So I'm going to start here with the dollar. I'm going to start with the UUP. It's a pretty good mirror of the dollar index, both in terms of what volume we see and so forth. So the main things to notice here is it's gone bearish now, right? It's also turned sideways. This was bullish all across the board. Still bullish, still young enough to continue on the long term, but definitely a transition taking place here on the short term. So let's look at that in detail. Here's the short term. This is a breakdown now of a swing point low. So we've broken it. That becomes a retest, regenerate bearish on the way back up. You had volume on the break. So don't expect this thing to turn around, especially for what the Fed did and now the way this looks. Maybe a bounce back into this and then a regenerate lower. Now I say that because you had volume on the break, right? And you've also got the bearish backdrop now. If you look at it on a weekly, you got an ABCD structure to take you lower and so forth. Speaking of the weekly, let's look at that chart. That ABCD structure here you can see more clearly. So you have this A point on the high to the B, right? Back up now to the C. And that C is going to take it right down to the bottom of the range. That's this far down here. That's where all the volume is. That's where this projection is going to take you. Don't expect this thing to stop until it gets there. Now that bottom, let's get the price point on it. That's 24.20. If we go here, it's going to be this bottom here. And so your range now looks like it is going to be probably off these lows back up. If you draw a range inside of it, right, you've got another range that's about right there. It's about equidistant. So you can see how those two ranges line up. And that makes me think that we are going to test this 24 area and probably get a bounce out of there. So with the price now stuck at 24.64, we're talking about another 64 cents. That's another 2.5%. That's still a fairly large move to the downside. And that comes after, right, if you go from the top to where we are now, it comes after a fairly significant move already. So that's the dollar. Dollar shaping up to try and push lower still. This dollar pushing lower is supporting all the other things that we've seen of late that have been pushing higher, and I kind of listed them all here. You know, you've got the basic materials, you've got commodities, you've got the whole industrial complex, all these debt instruments, and now the financials as a result of that. You know, as long as this dollar doesn't break that range and get some sort of a fast move to the downside, these all are benefiting from that. And it looks as if they're going to benefit farther in the coming days and potentially weeks. Now, the next piece of that, of course, is the euro, right? Because if the euro is too strong and the European markets press too far to the upside, get pressed to the downside as a result of that, then of course that could cause problems in our market. So if we look at the FXE to see what that one looks like, here we can see on the FXE the turn that's already started taking place where we've gone bullish, we're sideways, bearish. So exactly the opposite of what you see on the UUP, right? Just the exact opposite. So if we go over and look here at the FXE and look at the way this chart's drawn up, right? You've had some nice big spurts up off Draghi. Well, not off Draghi, but off the Fed here, the Draghi reversal, which seems now in retrospect to tell us that, hey, somebody knew the dollar was going to rise. And if we pull this back and look at it here on a weekly, you can see that there's quite a bit of space between all these highs and where we are now. Matter of fact, this hasn't even printed a high and doesn't look like it will. It looks like probably, well, it may still, but I mean, we're on a weekly. More than likely, we're going to test that top, and that's going to lead these two swing point highs at the high. And then going to the monthly to get a better perspective, you know, if you've got kind of this key part here is the range, and so a test up into that area still isn't going to threaten the European markets any more than they're already being punished. And that top, actually, it's about 112 to 113. That spike up was 114.5. We certainly could test that before it's over. And remember, this move, the breakdown was way up here, and we never have retested to regenerate lower. So over time, we actually could see this come back, test the top of this breakdown bar, and get back in to finally do the bearish retest in an attempt to regenerate down to the downside. So that's kind of the longer term view on this. Unless we get some sort of a fast spike in the dollar down and this up, I don't think this is going to cause the issue, right? Any kind of issue to the equity markets. It's going to take a fast move in these currencies now to cause that. Right now, the dollar depreciation is benefiting everything in terms of Asia. And as long as the euro doesn't go crazy to the upside, Europe's not going to get killed by it, even though it's not being benefited. And the U.S. markets are going to benefit mainly because you're seeing help in some of the other issues, in particular the commodity index, right, where oil is the wild card. And if we take a look at oil and spend our time here, this to me is going to be where the real issue is in the coming days and weeks. So let's take them one by one. I'm going to look at the fundamentals first. You know, at $40, you're starting to see, they used to say $60 was the break-even point where a well can make money or not on average. Now people are saying, and through advances that have taken place, about $40 is the number. Now, whether advances took place or whether the number was bad to start with, or whether this number is real, that's also a question. But, this is the number I'm hearing, and right now oil's trading at $40. So if I've got a well and if my break-even is 40, I might as well sell forward those contracts, right, and at least have that equipment operating. And so as we get at 40 or more, the rig counts begin to steady, if not increase. And I've got a bunch of details down here in the data section. So if you pull down here, there's a data detail section. You can see, and I'll just go through these and come back to the summary. You've got This was back at the beginning of the year. There was 813. Actual was 763. So the rig count went from 813 down. The most recent numbers was 618, went to 578. But what I want you to notice is even though the rig count is still falling, it's not in the U.S., right? Very slightly, right? We had huge drops back here, and we just kept dropping, right? Dropped over 100 now over the last about 3 months. And now we're down to a point where they're not decreasing. As a matter of fact, Gulf of Mexico, you saw an increase finally. And so you're seeing the rigs being put back online versus not online. That tells me we're getting to a point where the market is starting to see that the benefits of putting rigs back online is better than it taking them off. And here's the latest number. That was on Friday. Matter of fact, oil reversed on Friday as a result of this number. The rig count just dropped by 4 in the U.S. It was even in New Mexico. And again, the prior was 578, now the 545, which is almost all Canada. And I'm assuming Canada's break-even point is probably higher than the $40. So what's the point here? The point is that the data suggests they're at a point where oil isn't going to benefit anymore from less and less supply, at least not here in the States. And we're still talking about elsewhere just trying to put a cap on production, where you have Iran continually increasing now that the sanctions have been taken off of them. They're going to increase another 1 million barrels a day. And so if the rig counts are not decreasing, then you kind of go to the other side of it and it says, okay, what's happened to the inventory? Right? The inventory can increase or decrease depending on not just the supply, but also the demand. And demand's been very high. But here's crude oil back in the beginning of the year in terms of inventories. You can see what the inventories look like there. That was this area right here. Now look at what the inventories are doing. And that's even with record demand. Inventories going up. We're at a price point where, in terms of what oil is selling for, that the rig counts have stopped dropping, which means we're going to have even more inventory come online. We're not seeing inventory decreasing around the world in other countries. That tells me fundamentally we're probably about as far as we can go on the price of oil. So if we come back up here to the other part of this, so that's the fundamentals. I say it's the wild card because these are starting to get to the point where they don't make sense to continue. The next part of it, of course, is the technical picture. And I say there that, you could get another 10% higher to the top of the weekly bearish retest regen zone, but you could also get back to 30, 32 pretty easily. Let me show you what those look like. And so here's the charts. So I've got the weekly here. So essentially what you have on the weekly is you're coming back in. This was the bearish swing point low. You get to it, you go back up, and this was actually a retest regen off of this. It got over it, went steady for a while, then finally dropped again. Now you got another swing point low. You actually had, even though it hasn't done anything yet, you actually had more volume on that second test than you did on the prior low. You get the bounce up anyway. You're in that retest regenerate zone. Now 10% higher would take you right to the top of this bar. So you get to the top of that bar. Volume, pushing up last week wasn't that much this prior week, but you're into that zone. You can actually get up higher, although it was more than 6 bars. So, and we've seen this over and over. It shouldn't get up that much higher, but I'm not going to discount that it can't, given everything else that I've seen. But that's the upside, right? Another 10% potentially. Now, if you go to the downside, and I pull this chart up, I'm going to look at the weekly. The first thing to call your attention to is the doji on Friday on the release of those numbers, the oil rig numbers. It was up at the highs, dropped off into the close as a result of those numbers. Your bullish retest regen is off this swing point high. It's already tested it once. The breakout was right here, this bar. right? Immediate retest, went right down to the bottom of the bar. They bought it, they spiked it up after that. So now the question is are they going to be able to do more, or is this doji telling us something? And I think the doji is telling us something given the fundamentals I just pointed out, given where we are on the technicals on the weekly. It looks to me like you're going to get another pushback down here this week and come in here to test it again. If it breaks below it, if we get into this area, then you come back into the bullish retest regen zone. And that would be the first time back after 6 bars. That says you should stay in the top part of it. But, if it does get going, 32 looks pretty easy, and you could even drop below it to 30. So there's a lot of risk in this market. This market we know has a huge effect on the equity markets. So if we start to see this one drop, that's going to affect everything else. And that's why I say all is the wild card, right? That's the one that's going to tell us something if something actually is going to finally trade to the downside. Looking elsewhere here, qualified trends, intermediate term trends, they're actually suggesting some additional healing to come. And so if I pop over to that chart and bring it up, let me grab this so we can see it all. I want to point out this part of the chart, right? Because I'm looking at the intermediate term time frame. If you remember, everything was bearish here except for utilities about 2 weeks ago. Now look at it. There's only a few left that are bearish. Usually when you get 2 or 3 of these to turn, the rest of them is going to follow. These are your bearish ones. There's 3 of them left: healthcare, discretionary, and the financials. You've already got the sideways on the energy, the sideways on the technology, the sideways here on the basic materials. Basic materials and energies are close to turning bullish on this time frame. You've already had the move now in the industrials to bullish, and you still have the utilities there at that point. So what does this tell me? This tells me, hey, when you get 2 to 3, most all of them are going to change. That tells me that the ones that still remain are probably going to change. That says that we're going to get some more strength before we fall out of bed. Now, having said that, let's go back to this last point, which is that this feature, the technical feature right now, is exactly a repeat off the August lows. And let me show you what that looks like. And I'm going to use the S&P 500. Now here's this, straight up move. I want to point out one other thing while I'm here. You just did another ABCD structure, right? That's basically completed as well. You've been doing them all the way up. And if we go back to the largest one, right, which is the one that we were wondering if it could actually happen, right? It's already happened. We've already done that structure, and now we're working on others inside that. And so all the way up, we've seen these ABCD structures take place, fire and meet their targets or exceed them. And we've seen it one after another, right, where these numbers just keep going. And there's that one. That's the latest one. And so all these structures are almost completed. We had volume on Friday. That's what you'd expect. That says you're probably going to get a test of that high before it turns. I would expect that comes Monday morning, would be my guess. Now, let me show you what I'm talking about with August. On August, you had the big push down, right? So there was the big drop, right? Fast move to the downside. 2 weeks, huge drop. What did we have this time? From this top, 3 weeks, actually 4 weeks, the huge drop. You had a test, you had a test. Then what happens? That test leads to the strong move, leads to the strong move. Both of them, identical patterns almost everywhere you look. And then what finally happened? You come off fast, you come off hard, and then you reverse it and try to hang up there until you give it all up again. I would not be surprised to see something similar. So in other words, if I come over here and say, what could happen? We could test that high, get a fast move back down, right? And then reverse this thing and come right back the other way with another bar. That would not be surprising. Matter of fact, that would be more realistic that it would happen, right? Where can it go to? Well, the logical place is the top of this high. That's the 1993 area. That's where I would expect you to see some sort of a pullback. If you're into Fibonacci and all of that, right, you could do the projections. You could see the 33%, the 50%, right, the 68, probably in about those areas. That would bring you back into this bar. That bar has the volume. That bar was the top of the bearish retest regen on the first move back up. So I suspect that's probably where it would try to get to. And if we draw this in, you can actually see it. That's the area there. So the top is there, the bottom's down here. I'd expect that's the range we're going to see next, and we're almost at the top of it. So finally, going to the bottom line here, you know, I expect that hard sell down to come, but just like back in November, I expect them to buy it when it does. So what's the potential scenarios? Last week we were thinking that we would see some more up. I actually thought the S&P wouldn't be the leader, but it was. We did see the strength. The NASDAQ and the RUT came along as well. You know, what's the best case this week? Well, the best case would be that these other markets actually get over their bearish retest regens on the weekly basis. And so if we bring up the NASDAQ, draw them in, you can see where those price points are. Your swing point low is here, top is there. So it's this area, right? And so that would be to get to that area, either to the top of it, a full retest, or get over it. And if we pull up the Russell, you have the same sort of scenario there on the Russell. And there, let's draw this one. You got it in this area here. This is the swing point low that's being tested now. So again, up into that price point would be the extension. That's, to me, probably a best case scenario. And the S&P at the same time would be flirting with that top of the retest regen, trying to get that swing point high. What's the worst case? An unwind on the options expiration, right? Some sort of a reversal in the oil would lead to that first big setback. That would take us all the way back to the 1993 area. I don't know that we're going to get it this week, but I do think that is potentially on the table. That would be kind of the worst case scenario probably. What's likely? We don't have any failures yet, right? We don't have anything, and it's really oil probably that's going to drive the action. Is oil going to put in a reversal? I expect it's probably going to try, and I expect we're going to start to see that push back down. So if we go to the S&P, you know, we go up, we test, we start some sort of a push, maybe we finish it the week after that, and then they potentially come in and buy it. So that's kind of what I'm thinking this week as the more likely case. I think either of these two cases here, or more likely than that, unless this comes right at the beginning of the week, right, and then we lead to this happening. And I think all that is potentially possible as well. So, you know, we could get this happen the first 2 or 3 days, and then you turn around, do this, and potentially go as far as that. I mean, that's how crazy it could get, but that is the way it's shaping up this week. The rest of the data is here for you. One other thing I'd point out is I had talked about these long-term themes when I started the year. I was saying, hey, here's something to put on our radar. I expect we're going to have this play out. Now, this is, you know, we've already had the big plunge, and now we've had the V-shape back up. That fits with this scenario. The rest of it would be that, you know, maybe you make a potentially higher high before it's over, but eventually you come back down, you expand the range, and you get this sort of scenario. So that's the one that's still playing out. But if you look elsewhere, this has already happened, right? More QE in Japan and in Europe, more NERP, all of that business. These were the themes I wrote out right at the beginning of the year, and I've just left them on here so that we could come back and revisit them. I also said the Fed would likely do nothing or reverse course on the rate hikes. Boy, did that ever happen. As I said, I didn't expect it this soon, but that is what took place. I also said that I expect these things to bottom. I believe you've already seen the bottom in gold, the bottom in copper. I still think the bottom in oil is to come. We may already have it. We may test it again, but I think these things are all bottoming. So every single one of these is playing out, and I suspect they're going to continue to drive the action this year. So that's it for this week. Hopefully that gives you some insight as to what I'm looking at and can help you. It's a little bit longer than I expected, so I'm going to drop it at this. Thanks as always. Bye.